So when it comes to corporate restructuring, mergers, amalgamations, takeovers, acquisitions, spin-off, split, divestment, slum sale, demerger, in all these cases, valuation becomes very critical. And why valuation becomes very critical? Because none of these transactions that we have spoken about so far can be implemented, can be executed without the evaluation. So if Mittal Steel and Arcelor, if Mr. Mittal is acquiring Arcelor as a company, unless and until valuation of Arcelor is done, how will the transaction be done? And likewise, the recent example of Elon Musk acquiring Twitter. So unless and until valuation of Twitter is done, how would Elon Musk be able to acquire Twitter? And there are so many examples. Then there are so many examples. So whenever there are mergers and acquisitions, amalgamations happening, uh, valuations play a very important role. Valuation play a very important role. And why do valuations play a very important role? And that is because the shareholders of transferor company as well as the shareholders of transferee company will not like to lose anything as a result of merger or demerger or any other form of corporate restructuring. And therefore, valuation becomes very important. And that is why we need to understand as to what are the approaches or the methods that are used for the purpose of valuations in case of mergers and amalgamations. So number one, first of all, in case if the merger that is being decided about or the merger that is being considered is between two listed companies. If the merger is between two listed companies, then as mentioned in Ind AS 113, the pricing will have to be based on the quoted price of both these companies. So the quoted price of both these companies will become the basis for determining exchange ratio between these two companies. One of them is a transferor company and the other one is a transferee company. So that is number one, and that is quoted price in case of listed shares. Now, how the quoted prices are to be used in case of listed companies? Please remember, for that there are regulations brought out by SEBI. So SEBI regulations spell out as to how the quoted price will be used for the purpose of determining of exchange ratio, and that we will understand as we move forward. Number two, as very rightly said Prasanna ji, the second methodology that will need to be used is the comparable company multiples. And remember why comparable company multiples, and that is because again Ind AS 113, which is on fair value measurement, and it gives a valuation hierarchy, and as per that valuation hierarchy, in case if the merger or in case if the valuation has to be done of a company which is not listed, then the valuation will have to be done using level 2 input. And what is level 2 input? Level 2 input is observable data, and that means finding out a comparable company and using the price of the comparable company decide the value of your target company. So, what are the comparable company multiples which are used in real life for the purpose of valuation of the mergers and amalgamations? So, the multiples can be divided into two groups: financial multiples and the non-financial multiples. So, just to give you an example, financial multiple can be PE multiple, number two EBITDA multiple, number three asset multiple, number four sales multiple, and so many other multiples that we have discussed in the past can also be used depending on the situation. So how relevant a particular multiple is, it can be used for determining value of a company using the comparable company method. What are the non-financial multiples that can be used? So it can be depending on what the target company is and what is the product or the service of the target company. The non-financial multiples that can be used for the purpose of valuation of a target company can be per bed multiple, per bed value multiple, per room value multiple, per subscriber multiple, per tower cost multiple, and things like that. So that is your second model, and that is a second method, and that is comparable company multiples. Number three, what is done in real life for valuation of the companies which are undergoing corporate restructuring is book value method. But remember, book value method is only used in conjunction with other methods. A book value method will rarely be used as the basis for deciding the exchange ratio. It can be used to adjust the weightage, but solely book value method will rarely be used for the purpose of valuation. And why is that? Because when the merger is happening, invariably merger will happen between two companies which are going concern. Since the two companies are going concern, obviously their valuation will need to be done based either on the market approach or on the income approach, and not on the basis of book value approach, right? But still, book value method is also used for the purpose of determining valuation in case of corporate restructuring, mergers, and amalgamation. Number four is income or profit earning capitalization method. So all these points that I'm discussing with you, all these models and the methods that I'm discussing with you now, remember I have already discussed them with you, and therefore I am not elaborating them in too much of detail, because I am sure you would know them in any case. So income capitalization method, or which is also known as profit earning capitalization method, can also be used for determining value of a business. And number five, and very rightly said Baman sir, and that is your discounted cash flow method. I for one would always think that discounted cash flow method is the most dependable, reliable, authentic, accurate method for determining value of any business. Only precautions that need to be taken is, number one, the projected cash flow got to be as realistic and as accurate as possible, and they got to be completely based on the accurate informations. And number two, the cost of capital which is used for discounting those future cash flows should also be a correct representative of the risk and return of that business. And that is what is required. And then you use the discounted cash flow method. Discounted cash flow method gives you the fundamental price. And since it gives you fundamental price, it obviously becomes the most authenticate. So instead of talking in terms of using the comparable value as the prime value and using the discounted cash flow to back it up, I will put it other way. Use the discounted cash flow value as the prime method and support it with the observation using the comparable company based valuation. And this is how I would look at it. Friends, when it comes to the mergers and amalgamations and corporate restructuring, in real life, please remember, it's not that one of these methods or two of these methods or three of these methods are used. In real life, they are always used in combination. They're always used in combination. So, and there is no restriction that you can't do it. So it is possible, depending on what is your view as the valuation professional, what is the view of the transferee company and the transferor company with regard to the valuation of the two companies. So the valuation can always in the combination. So you take discounted cash flow, you take the comparable company method, and you also take the book value method, and then assign them weightages, and based on those weights you can find out a combined value of those products actually. Yeah, so this is how it can be done.